most in terms, that is why we conduct an audit. When it comes to compilation, it's not like the public does not stand to lose. The risk of losing is lesser. But you must understand that none of this here is absolute assurance. We can't, because I told you, we created those estimates. So depending on the quality of the information, that if the information is of a bad quality that was in the system, and nobody picked this up, and we actually had a bad accountant which actually produced bad information over bad quality of time, none of this might actually pick it up in the first initial stages until somebody actually realizes over a period of time. The problem is that we need to realize very quickly in the current market, as Prof is saying, we have tools, we have techniques. It shouldn't be 10 years or 11 years. Within year 3, we should be able to pick up, even year 2, that something isn't right, and we need to self-correct the quality of the information. Okay?
Now on opinions, expressing opinions, if you're doing a compilation, do you express an opinion, yes or no?
Do you or should you?
How many of you say you express an opinion? Just by a show of hands. No. Now why do third parties rely on your signature when you present those financial statements?
Or why do they come to you?
If you never gave an opinion, I can go to, it's like what people do is, they take it to a backyard accountant. Isn't it? You do express an opinion, but you don't express it in words. It's implied in the way you structure your report.
It's implied by the fact that they came to you as well.
Let me show you what happens is, how many of you people in your compilation report state the financial statements are prepared on a going concern basis? Do you or don't you? You do. Is that an opinion or not? It is an opinion, thank you. How many of you state that the financial statements fairly represent the financial performance, financial position, as well as the cash flow? You do. Is that an opinion or not? How many of you state that I have relied on the information provided by management? It's an opinion. How many of you state that I have reviewed the accounting policies and found them to be appropriate for the business? You do. So if you say you don't express an opinion, then I don't know what an opinion is. Because you do express an opinion, the manner in which you write your report, but you don't state it explicitly, like an auditor.
And even if you go one step deeper than that, the fact that you compiled it, and they came to you to compile it, they came with somebody who actually has superior knowledge and technical acumen to actually compile it. So the fact that you actually associated to it, all that is now your opinion. It falls into the realm of, it's part of your quality, it's part of you, which means you're associated with it. You can't disassociate yourself from it. Because the argument then would be, what were you actually doing? So why did I come to you, and what use are you to me? That is why people don't go to GPs for flus. Because they'll say the whole point is that I know what I need now. It's the third time in a row. I'll go to the pharmacy and get the medication. That's what happens in most countries.
Now, with your review, how many of you agree that when you express an opinion in respect of a review, they tell you either it's a moderate opinion or a limited opinion? Isn't it? They tell you that when you do an independent review, you express a moderate or a limited opinion. I'd like to see someone give me a limited opinion. It's like saying, I'm alive, but I feel dead. Is that a limited opinion? Or you go to a doctor and the doctor say, you don't look so well, but I think you're in good health. Is that a limited opinion? Yes. So no opinion can be limited. Neither can it be moderate. Your opinion is linked to your objective of the engagement. You always give a full opinion. I'd like to see that when you were studying, After writing your exams, your lecturer wrote, you failed, but I think you're good enough to move on. That's a limited opinion. You either fail or you pass, isn't it? There's nothing in between. And that is what a review does. It gives you an opinion within the confines of what your engagement is. So it's a full opinion. It's never a limited opinion. And when you look at your review, your opinion is limited to the material misstatement of information presented in the financial statements. So can you say there are material misstatements but rely on the financial statements? You cannot. And that is why there's no such thing as a moderate opinion, a limited opinion. It's all farcical.
But we are moving, and Prof always says this, we are moving to a realm with the way, again, technology is moving in the next 2 to 3 years' time, or even in the next couple of months. We are moving to a stage where there can be absolute assurance. Because what is happening is technology is basically controlling the entire system. So in the future, the reviews, there'll be much more reviews than audits, because basically we have to review the credibility of the system. It's not going to be so much about what we're currently doing now in terms of looking at elements within the system. The system will be on the blockchain, it will be tight. We'll have to make sure that whatever is controlling, or the internal controls around the system, so there'll be much more reviews in the future and less known audits. In the future, audit is actually a declining or almost dead profession like bookkeeping.
And that is basically what it says. The first opinion you expect to express when you do a review or an audit is to give an opinion on whether you can rely on the compiler or not. Because if you don't do that, then you're violating your independence. Can you compile the financial statements and audit it?
No.
No. But do you agree that you're relying on someone else who compiled it for you? Isn't it? I haven't seen any of that in an audit report.
But the issue is, do we trust each other and embrace each other as peers? And the answer is no. And that's the reason why not. Because everybody knows there's a level of lack of professional judgment and competence around the way. You give the auditors what they want, and they take what they want from you. It's like you preparing for an audit. That's what most people do. It's a tick box exercise. I want to talk about the appropriateness of accounting policies here. So what is the biggest argument on this point is that the accountant always says that we have no involvement. We don't actually select the policies. Management decides on the policy. But the biggest criticism these days is that if management doesn't even care about signing the financial statements, or what does management really know about what is an accounting policy and what is the impact of an accounting policy on the business? The answer is probably management doesn't really know. It's the accountant who basically tells management what the policy should be. And this is where it all goes wrong, on how you start crafting these policies. Because once these policies are crafted, remember, you can't change them every year because it costs too much of money to go back and change them. So at any point in time where the policy is not relevant, it's not crafted appropriately, it's not linked to the business model, and it doesn't make economic sense, is where the problems start. So the first line of defense is usually the accountant when engaging with management in what should the policy look like and how much information do we want to give. So the whole idea these days is, it's called reduced disclosure. People want to know basically risk-based information. Information that is going to affect me, that's going to affect my business, that's going to affect capitals coming into the business. They don't want verbatim technical information that is currently being printed out of the system, which means that at any given point, you have to actually go to the accounting policy and go and simplify and delete information from that policy and link it to the business model. And how many people do that? Nobody really does that. Most people just actually generate the policy straight out of the system, or they wait for the new patch and they generate it. And when there's an issue and people go back and inspect that policy, is where they say you did not apply your professional competence. And it's even worse when the policy gets duplicated, because sometimes the computer duplicates the policy, because that means more than that, apart from your client not reading, you didn't read the financials yourself. Because there's no way you would not have noticed the policy got. And you'll be surprised at how many times the system can generate a policy 2 or 3 times by mistake, and people don't pick it up. Okay.
Now we're looking at this, the accounting standards and what are the objectives of financial statements. The first objective is that you must provide information about the economic resources and obligations of the organization. And what I find amazing, people only decide to revalue assets when they go to the bank for a loan. Isn't it? Then we want to state, no, now we must have assets. But the bank goes and they look at your financial and they see revaluation surplus, which wasn't there last year, it's now here this year. Then they already downscale your assets in any event. And that's the risk of not applying your judgment in terms of what are the economic resources under the control of the business.
This is called reactive and creative accounting. And it comes down to the behavioral trait of the accountants again. Remember, by doing that means that you're a reactive accountant, which means that you're not actually creating a sustainable business. It means that you're trying to look for shortcuts and you're trying to actually be opportunistic in the market, which is against public interest. Because by the fact that you actually did that at this point in time means that you actually didn't have the business objective in mind. You're doing it to react to a situation. And that is actually dangerous in a behavioral trait of an accountant. Okay?
The second one is where you now need to look at your operations. Like you said, you look at your operations by looking at your statement of financial performance. Why do you prepare the statement of financial performance or your income statement? Anyone? Why do you do it? I know the common answer is IFRS requires it. Isn't it? But why do you do it?
It shows you the economics.
It tells you about two stuff. One is about management. Are management of organizations using the resources effectively, efficiently, and economically? Because the answer of those three is encapsulated in your profit. So if the company is not making significant profits, fire the managers. They're not doing their jobs. Because they're not utilizing the resources for which they have been acquired.
And then that is what we don't explain to our clients. It's economic profit. It's not monetary profit. In the sense that that profit has nothing to do with the cash sitting in the bank. You have to do the reconciliation between the economic profit, which is sitting in the statement of financial performance, to your cash flow statement. And most people actually don't explain to their clients what is the difference between the two types of profits. Because your cash flow also does show a profit. It shows the cash profit in terms of working capital. It shows the cash profit in terms of financing activities, etc. But there's a reconciliation to the income statement. And because there's no accounting standard to show the reconciliation, most accountants actually just tell their clients, you know what, don't worry about this. This is just accrual accounting nonsense. It doesn't make sense. Forget about it. But it's not the truth. That basically shows you exactly your efficiency and how management has performed. That is why it's called a statement of performance. It actually should be called a statement of management performance, if you think about it.
And when I do financial statements for clients, I actually call it your performance appraisal report. That is what it is.
And that's why there's a lot
It
of
tells
risk.
me whether management, did I employ them for the right reason? Because if you are employing managers to do work, then downgrade them to workers. You employ managers so that they can use their skills from the shoulders up. And that is why when you employ managers, don't look at what their physique is. Look at how sharp their minds are to make decisions at the right point in time so that the organization can benefit. And that is what that must tell you.
And also, that's the most riskiest statement. Because remember, the cash flow statement, you can't lie. Because that is generated from the bank, from your bank statements. But this is where people lie, is because everything in the income statement is where you can manipulate and you can cut off. So that is where you have to look at the risk base to what is your revenue policies, what is your write-off policies, etc. And you have to then tie that to the working capital in the cash flow statement to see if the working capital cycle in the cash flow statement has any correlation to what you put there. Because that's where you actually see that there is actually a problem and where managers has underperformed, we've overlent money. Let's look at Edgar's and the Edgar's group, for instance. I mean, anybody would tell you that Edgar's or the Edgar group was problematic. Why was that? Because they were actually lending money, I mean, selling goods to people who actually would never ever pay them. It was obvious. So if you looked at their income statements and their sales, over a period of time, the share price went up, everything went up, because why? They actually just were granting recklessly. But if you look at the cash flow statement over time, you would have realized that this company actually was not reconciling the two. And there would come a point in the business cycle where what? Creditors would not be paid because there's actually no money coming in. Do you see that? So it's a good management tool, and it's a good tool to actually reconcile the two statements.
Now just on that, if a company's revenue increased by 30% over 2 years, but the profit declined over the 2-year period by 20%, good or bad? Bad. What happens if I include and I tell you this in my financial statements? The reason the profits has not been realized because we implemented a strategic decision in terms of generating revenue of which the benefits will only be realized in 2-3 years' time. It changes your entire perception. Do we do that? No, we don't. And that is where you start adding value to financial statements. The third one is providing sufficient and reliable information. The easiest thing is that numbers can be used to lie. Isn't it? If I come to you and I tell you, for example, in South Africa, only 1% of the population is raped. Is it a major concern? 1% of a population is raped. It sounds insignificant. What happens if I tell you every 5 minutes a person is raped? Then you're in total shock. And that is how numbers are being used. And that is what we don't tell our clients when we give them the financial statements. That the numbers are there. And it's very interesting. You'll see sometimes people will use the actual values and sometimes they speak percentages.
That is why there's an area in accounting, or there's an area to move. You might hear the catchphrase, the qualitative accountant. What do they mean by the qualitative accountant? Is making meaning out of the numbers. Is where we have to now explain what does the number actually mean to the people and express ourselves in terms of what does the number mean and what is the number going to influence. And that is why the whole concept of integrated reporting came about. But if you think about it, we never needed integrated reporting. If we wrote our accounting policies, because accounting policies does not prevent you from explaining further significant economic events surrounding the policy. And that is what they're talking about, the qualitative accountant. When you see financial statements, you see numbers, and you don't see words underpinning those numbers in the policies, you know very, very quickly that those numbers are meaningless information that we can't actually apply.
The fourth one is that you must give a true and fair reflection of what the information is. How do you decide whether the information that you present in the financial statements are true and fair? Anyone, how do you decide that? Because you all say so. Don't you look at the accounting records? Okay? But do you agree that the accounting records is a result of the operations which underpin it?
True.
Do we speak about the operations? No, we just worry about the numbers. Like I can tell you, For example, salaries increased. Did I tell you that I expanded my business 50% by employing more people? No. And that is what we're not reporting on. The underlying substance which generate the numbers. We're just interested in numbers. It's like, what happens if your kid comes home to you and he tells you, I wrote a test today and I got 100. What do? Excellent. You hug him, you don't know. Let's go to the shop. What do you need? Isn't it? And after you bought him what he wants, you only found out late in the evening it was 100 out of 800.
But if you look at it again, in terms of when you think of competency, do you ever ask your doctor, how much did you score 51% or did you score 100% in your exam? Because any medical school will not give you the final year results in terms of percentages. You'll say either competent or you're not competent. So if you're applying the same principle to accounting, you do realize that those numbers actually are very dangerous. We actually have to very carefully contextualize the numbers in a very clear and uncomplicated way. Very quickly, what is the influence on the number? So what? And if you have to keep asking yourself, so what? So what is the economic impact? So what to society? And if you just keep asking yourself those questions, you'll see, you'll draw those one or two extra sentences that actually just makes more meaningfulness to the numbers.
And just to illustrate that, assume that you need a major operation. You're sitting there with your specialist and he tells you that out of all the operations I conduct, 9 out of the 10 survive. And you ask him, which number am I? And he tells you that you're the 10th. What do? Go ahead. No. The same thing would apply if you come to a doctor and he tells you, you're my first patient on whom I'm going to operate. Do you say, go ahead? No,
Depending on your tolerance for risk.
You'll say, don't worry, I'm first going to provide you with other people to practice on. And when they survive, then I'll come. Isn't it? And that is what we do. But that is the type of information we're not speaking about in the financial statements. And that is what principles are all about. Telling what fair representation is. The financial statements must also tell you about the future. You'll see that financial statements must be predictive in nature. And that's the reason why they ask you for comparative figures. So that you can see the pattern and the trend so that you can say, yes, in future, the company will still be there tomorrow.
And on that point on trends, the reason why I'm saying the qualitative accountant is you must understand that in the current economic environment, every year the economic situation changes too quickly. So there is more to write, more is better, because sometimes there's actually no comparability between the financial statements because the business has changed so much, economies has changed, you actually have to reconcile those two things. Do you see that? And the main thing is that also the legislative environment, depending on what legislation underpins your accounting, it also then drives your business models, etc. So you have to look at what other pieces of legislation is tying together that is driving this policy, because that affects the business to continue.
How many of you find to maintain your knowledge on IFRS difficult? Or to keep yourself updated? Isn't it too much?